Hi, everybody. Today's podcast will be the first in several chats with friends from different parts of the global financial and corporate world. Today, we are joined by my friend Phil Gillam. Phil has spent most of his working life on the trading floors of major global banks. He now lives in Dubai, like myself, and now is helping to build a small boutique broking operation here in Dubai. He writes a pithy and insightful market newsletter. Welcome, Phil. We
Thank you,
have
Simon.
much to chat about, not
Indeed.
least the renewed war in our region and the potential consequences for the global economy.
Indeed. Quite an appropriate start to the day as well, because I've read that there's been some strikes on the UAE and Kuwait and other regional countries from Iran overnight, although I haven't had my usual customary alert on my phone so far. So it's only what I've read.
I did not also.
No.
I think strikes were probably in Abu Dhabi. But I think the big issue here is that Iran has the Strait of Hormuz as their leverage. In contrast, America's Achilles heel is the stopping the flow of Saar crude through the straits, because in a month or so's time, America's emergency stocks of Saar crude will be exhausted, and that therefore means shortages of diesel and other essential products that keep the economy ticking. This, I think, really means that Trump sees he has a span of only a month or so before his stocks of diesel in particular are exhausted, in which case the consequences on the US and European economies will be very profound.
Agreed. Although I've, in my career, focused on commodities and emerging markets, oil has always been my Achilles heel. I've never really understood the market, although I did see this morning that, and I think the first signs of it was on Friday, that crack spreads have spiked and that margins now from refining margins are actually almost the same price as the paper oil price. So if that's the case, then it highlights what we've always thought, that actual physical oil is trading at nearer 200 on the open market, as opposed to the paper price, which is manipulated. Well, we say it's manipulated. That's the
Well, you can see it in the huge short position.
Yes. So, yeah, I mean, as you know from my recent notes, my biggest concern has always been not so much the oil supply, although I think that is a big issue, but it's actually also the refining capacity, and that's not just confined to oil; that's across all products. And what was going on, particularly in Russia and Ukraine, where they're basically striking each other's refining capabilities. The global refining capabilities are being reduced quite dramatically, not just in Ukraine, but also I think there was a big refinery taken out in Australia, one in India. So the refining capacity, bearing in mind, by the way, that there's been no real investment in refining for a significant number of years. I think the last refining in the US was a 45,000 barrel a day add-on, bolt-on in Dallas, and that was 2002. Prior to that, the last refinery built in the US was in 1977, quite some time ago. But anyway.
just to add to your comment, when the large, I've forgotten where in Russia it was, refinery was hit, and Putin announced cancellation of all diesel exports, we saw a huge spike in the diesel crack spreads. So again, just to emphasize that we should not be looking at the market price of crude oil, but we should be looking at what's inside the barrel, because what's inside the barrel and what the prices are doing tells you the real physical impact and not the price of the barrel of oil. I mean, we did an analysis a couple of weeks ago comparing diesel, phosphor, gasoline, and other product prices starting in February before the war and taking prices up to the end of June. And the average global increase, so it varied from region to region, was a 30% increase in the product prices compared to a fall from peak to trough, 33% in the price of a barrel of crude oil. That illustrates, I think, just what is going to hit markets once America depletes its reservoir, its reserves of sour crude oil.
Mhm. Well, it's not just the US that's depleting, is it?
Oh, it's
I think
global.
if I'm led to believe correctly with the IEA, the US agreed with 32 other member countries to basically use their reserves to try and smooth out this period. But where Trump is always quite clever is obviously with the US, is obviously which creates a problem further down the line, is the fact that you didn't buy that oil, you borrowed it, and you borrowed it at a premium, and you borrow 1 barrel, but you must replace it with 1.25 barrels
Correct.
over
Yeah.
whatever your contract is. So really, with the markets also, I mean, that's a delayed demand that's going to have to come back, but also China, who seem to have preempted what was going to happen after Venezuela, stockpiled, and it's them not actually coming to the open market that's actually allowed the suppression of the oil price now. The question how long their reserves will last, well, they're quite considerable, so a lot longer. But they've done their bit in trying to stop a global catastrophe by actually going off their reserves.
There's one flaw to that argument, which is all of that oil acts as collateral to local governments who have borrowed excessively. In fact, they account for 42% of China's debt. So that collateral really is not available to the market.
I did actually read something about that, but yeah, I'm trying to think what obviously what the implications of that would be.
I think the other implication is that, from what I heard, is that the small refineries in Shandong province, instead of operating at an average of 73%, have dropped their rates down to 61%, rather implying that physical consumption of oil products in China sank sharply. And government introduced various measures to help reduce the demand for oil. So it actually rather implies that China's economy is not functioning as strongly as a lot of people think. But Phil, what do you think are going to be the economic consequences of what we're seeing at the moment, particularly in your sphere of the world, the financial markets?
That's a very interesting question. Obviously, the first thing that comes to mind is obviously the spectre of inflation, and that's not just that. Obviously, you've got two camps here. You've got the demand destruction side, which would basically imply recession, and the job numbers and recent data actually highlight that. And not just you've got the recessionary side, but that brings us on to what actually is going to happen with Walsh, the Fed chair, as to what he's going to do with rates, because the market now thinks that he's actually going to raise rates because of this inflationary impact. But I actually think that 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 that's misleading. I think he's actually going to do the reverse. I don't think the Americans can afford. I mean, if let's put it this way, right? If the crack spreads are telling us that there is going to be inflation, you're going to have inflation from the fact that you're going to have less products because there's no helium. There's going to be less food because of fertilizers. These are all issues that are further down the line. Short term, the markets don't really want to pay attention to that. They're fairly anesthetized, and I think the market still thinks that we're going to have rate rises, but as we get closer, I think rate cuts, then I think the markets will probably go up. But a lot of this is actually to do with the dollar as well. The dollar has been very strong recently because obviously the perception is that Walsh is going to raise rates, and that's caused a few hiccups.
To add to your
Sorry, I'm not articulating this very well. Sorry. Apologies.
no, come on, it's not an easy one. To add to your thinking that Walsh will cut rates, if he raised rates, there would be huge problems in the credit markets. Big enough problems at the moment, but to raise rates would probably cause failures and bankruptcies.
I agree, but obviously the commodity complex, because the dollar has been so strong recently, that's weighed on the commodity complex, and that's actually to a certain extent actually helped, particularly with the oil as well. But ultimately, if you think about it, right, the problem the US have, and let's go back to Stephen Mirren, the ex-member of the Fed, who wrote a very good strategic article about trade going forward, which pretty much the blueprint of which Trump has adhered to, which is tariffs, largely. But what he really says in his paper is that the dollar is overvalued compared to its peers, and he wants a weaker dollar. And ultimately, when you listen to Trump over the last few years, he always talks about the weaker dollar. So you have to ignore the likes of Besant, who says we want a stronger dollar. That's what I'm saying is a complete misconception. And funny enough, Steve Mirren actually resigned his seat on the Fed to make way for Kevin Walsh, who was seen, as somebody who's going to come in, bring in fiscal discipline. And Trump said, you have to do what is right. But ultimately, right, I still think he's going to cut rates. He's going to surprise the market. And for markets overall, I can still see a case where the markets remain strong and go up because central banks are going to keep printing. And not only that, it's an illusion. The market goes up 10%, but the spending power of the dollar is actually weakening over time. So I can actually see a paradox where basically the markets continue up, but actually a weaker dollar is the end product. But they've got to service 40 trillion of debt, right? And you can't do that with higher rates.
That's 42 trillion of government debt.
Yes, well, yeah, I mean,
Total debt in America last year, when you include corporates, financials, and households, according to the IIF, was 104 trillion, and the rest of the world was 264.
yeah. Well,
And
Raoul Pal summarized it quite nicely, where he said valuations on companies are almost irrelevant now. It's about government printing. And he, if you check out some of his posts on X, he explains it quite well. And shows exactly, the correlation, the necessary correlations. But basically, he just says that the markets are just going to go up because there's just more money about. But it's an illusion to think that you're actually making money when the index goes up 10%, when the currency devalues. And to that end, obviously, we do know that something is probably going to come, given the unbelievable scale of gold buying by the Chinese. Because they clearly, not just the Chinese, but most central banks are buying gold because they can obviously see they're printing and they can see what's going to happen to the fiat currencies, and they don't want to be left holding.
I think that what Beijing is doing in opening up the Hong Kong trade in gold and the Chinese currency is really is pointing the way forward into the RMB being supported by the gold that they own. And in fact, there's some pretty learned papers that I've been reading saying that China has to devalue the domestic one whilst keeping a firm grip on the external one in order for nominal incomes, assets, etc., to rise faster than the domestic debt. So really, we should be focusing on the one gold price and not the dollar gold price, because that, I think, is going to be the lead indicator.
That's interesting because when Trump embarked on his tariff crusade, a lot of people were actually looking to China to actually cut and devalue the yuan as a sort of like a countermeasure, but they didn't. And it's interesting you say that. I can't get my head around because the it doesn't fit with the devaluation of the yuan to me, because now we can see that the Chinese economy, regardless of the certain issues they have internally, it's still the most powerful economy now. And one would assume that at some stage they're going to assume hegemony, if you like, which is why I think they're preparing the yuan to be the world's reserve currency. That's where I see it going anyway, personally. And the way that they're buying gold would suggest that they see that too. The devaluation side, I can't really get my head around. I'm not an economist. But they've done various things. They've abolished leverage trading on metals, particularly gold. I think on the 24th of July is the cut-off point that anybody who hasn't voluntarily liquidated their margin position or their leverage position will be closed. But they're encouraging you to hold physical or one for one. If there's an ETF, it has to be literally one for one and fully backed by gold. They're also offering, I think, 1% interest now in bullion on your
Yeah.
gold holdings.
Yeah.
So it's all to encourage, gold ownership, and also one would assume that trust in the yuan, in the currency. Ultimately, if it's fully backed.
What it also tells me is that China is moving in the direction of holding physical assets, whereas the West in general moves in the direction of holding paper assets.
It served them well in the West, but I think that they will have to that will have to come to an end. I mean, you can have, like I say, if I give you an example, there's a security that I bought to market when I was at HSBC. It's called Gold Bullion Securities, and it's an ETF, but it's actually fully backed by gold. So if you actually phone up for a price, the person that actually makes the price is the bullion trader. So he cannot sell you if he sells you the shares, right? He then has to buy the bullion. And HSBC have two vaults, one for the physical gold trading they do on the LME, etc., and one that is literally for gold bullion securities. That's what the Chinese want to create, is that situation. Whereas most of the ETFs in the US are fairly liberal with, they you don't have to be fully 100% backed all the time, and that's been exploited, and obviously is an issue that kind of leverage will not be able to occur in China. So if you hold an ETF, it's fully physically backed by gold, and that security, in theory, you can take that gold bullion security to any branch of HSBC and exchange it for 1/8 of a troy ounce of gold. So the going to physical is very important. But I think Citibank recently have joined the LME bullion ring, because I think it's a sign that somebody's actually joining the physical ring, because that's where they see the future,
Yeah.
physical trading.
Well, I think for ordinary households, etc., my suggestion is that when you have a big rise in the equity markets, you should take your profits and put the profits into physical assets like gold or silver. That's going to be your security
Mhm. Well,
as we go down the line. Yeah.
Well, it's interesting, isn't it? Because actuaries will have you believe, and it has worked for a long period of time, is the 60/40 portfolio spread. 60% equities, 40% bonds, because bonds were basically the insurance. Well, sovereign bonds are not the insurance that they were, and China is slowly divesting all of its treasuries, and eventually, you know, the security that you once saw with sovereign bonds. I mean, European bonds. I mean, I wouldn't want to buy gilts now, would you? Given the
Not
state of the
no
British economy, I think it's on
point
the
euro one.
IMF's.
Yeah.
Yeah. So the portfolio spread has to change. Now, there's been various articles I've seen where even if you just made each portfolio have 1.5% attributable to gold or to mining per se, to commodities, right, the demand would be exponential, right? Um, so, and and that is something that can insure you against fiat currency risk, and against in theory, a market turndown. But at the moment, with leverage, gold is trading like a risk asset. You know, the market goes up, gold goes up. The market goes down, gold goes down. Um, I've always been uncomfortable when when there is a big sell-off, that all the asset classes sell off together, or when it goes up, everything goes up, because it's telling you that the the old dynamic that we understand of stronger dollar, weaker gold, and vice versa seems to the correlations seem to have not broken, but be not working at the moment. And I think we need to get back to a position where I think we will get back to a situation where things will revert to the norm as we know.
Do we get to that position before we have a major crisis, or does it happen after the major crisis?
I think after,
Yeah,
personally, I mean, if there is a crisis, and a lot of people are trying to call the top of the market, etc., or saying that they're going to see a 20% drawdown, um, there's so much leverage in the market that you will get an all asset class sell off. And to me, that's the opportunity where you would just accumulate more. So, I think it's a storm you can weather if you're in gold. I'm not so sure you could weather it if if you're invested in other assets. And I say gold. When I talk about gold, I'm not just talking about gold. I'm talking about all commodities, including silver. The 54 critical minerals that the Pentagon put out. You've got to own them longer term, because they're critical for a reason. Um, I see any drawdown, everything's going to get sold off. That's because of the margin in the market. I mean, you
yeah.
see M2 money supply goes up at the same time. M2 goes up, margins going up, right, in the market, and there is still far too much leverage, and we haven't even talked about the yen carry trade either yet.
Yeah. I mean, our view is that next year is going to be a recession year. And I think that will remove a lot of the leverage out of the system, which will lay the foundations, starting probably fourth quarter of next year, for the last, as I call it, hurrah in this very long cycle that will peak sometime 2030, 32. And that period will be reminiscent of what we saw between 1978 and 82, which is basically stagflation, dollar falling sharply, all commodities rising exponentially. But when you convert them back into $23, $26, you're back to the similar prices as of today, other than gold.
Yeah.
So,
Well, one of the main paradoxes to me is, people are investing in, you know, AI technology companies, um, and these companies just aren't making any money. And the capex is phenomenal. Whereas whether it be gold mines, copper mines, I saw copper mines are trading at a discount to the underlying copper price now. Gold shares, I mean, gold, the actual gold shares themselves, if you look at the ETF GDX, or GDXJ, the juniors, and you go back to the beginning of 2000, and you will see, well, actually, if you go back even further, what you see is that they're cheaper now than they were when gold was at 1500 to 2000, which
because
just doesn't make any sense.
all the capital is being thrown at the one bull sector.
Exactly. But I mean, if we go back to 20, 30 years, right? People always complained that capex was too high in mines. It wasn't worth, it was always risky investing because the capital expenditure, etc. Now, right, these companies are spending billions on an AI that we don't really know if it's going to come to fruition or if they're going to be there in the future. But that's good, right? What was bad for the miners suddenly is now, um, we're in a new paradigm.
Yeah,
To me, not just the underlying commodities, but if there's a sell-off in the mining sector, which there nearly always is, I just think they're a great way to enter the market and
I
get
agree
exposure longer
completely.
term. I
Yeah.
mean, a lot of people don't realise that they've been making so much money, and bearing in mind their recent numbers, if you look at Newmont's recent numbers, record returns. What people don't realize is those returns are based off of a mean price of $1,500 an ounce on gold and on $30 an ounce on silver. I attended a mini mining conference held by National Bank of Canada recently, and met a lot of the companies, and none of them got drawn into raising their base price in the recent run up. They've left them. They left them down at the lower levels, but they're still printing money. And they're making so much money that they're buying back debt. Most of them have got no debt, and now they're doing share buybacks. And there lies the irony, is if you actually look at the AI companies, their capex is so huge now, they've stopped buying back. And that's a huge thing for the market. The share
Signal.
buybacks have been a big part of the recent run up, and that's gone now. If you look at all the Mag 7, right, they've all stopped buying back their shares. But the mining companies are buying them back. That's where you want to be.
Mining companies learnt their lessons from history.
Well, yes, you know
Yeah,
my thoughts on that. You know,
yeah.
um, in one of my recent notes, I did actually say that AI can't survive without the metals and the minerals. And the miners have been around for thousands of years, and they'll remain around as long as AI is about, because AI has
Sure.
actually made them more important than they've ever been. In the past, you could argue after the abolition of the gold standard that what was the point of actually investing in gold and silver? In theory, that was Gordon Brown's mantra. It doesn't yield anything, so it's dead. Um, so you could argue that period, why would you? But obviously, going forward with AI, they need it.
Yeah.
They're going to be big demand at some stage. I think
So what would
Samsung.
be
Well, I was just
what?
about to say Samsung. So if these companies have to persist in high capex, I think it was Samsung actually invested about. It was only a small amount, but they invested $5 million in a Mexican silver mine that actually had closed. The cost to the company of buying silver was becoming so difficult that it was cheaper to buy this mine, stick 5 million in it, open it up, and basically get paid in whatever resource they took out. I thought that might be the first sign, but I can see a case where if you're a serious AI company, it's cheap and you want to fund your capex, go and buy a mine. You A, get the resource, and B, you can sell what you don't require and fund your AI expenditure. But
Very interesting thought. Well, Phil, what would be your parting comments? As I think it's time that we brought the chat to a close.
parting comments, wow. Well, we didn't touch on it, but it's to do with the dollar, and it's quite funny. I've actually thought that the Achilles heel in the market was bonds. and particularly with the Japanese situation being so precarious, where they've got a debt to GDP ratio of 235%. And obviously they're trying to defend the yen. And what worries me in the market, and what I think people should be focusing on in the coming weeks, is there's been a big shift. The funds in the market they have the largest short position in the Japanese yen they've ever had.
Wow.
And ironically, because they thought Walsh was going to raise rates, there's the longest. Everybody thinks that there was a bear market position in the dollar. That's reversed. It reversed in 7 weeks, and the market is now net long, massively long the dollar. Now the Japanese announced last week that they're going to encourage Japanese insurers to start buying domestic bonds. So to me, the real danger is is the counter-cyclical trade, is if everybody's short the yen and long the dollar, the complete reverse is going to happen. I can't articulate it, but there's a good article I read online which was explaining how sensible buying by the Japanese institutions, insurance companies, and pension funds could actually create a scenario where we have a much stronger dollar, which is what the Japanese want. So let's see. That to me is where my focus is at the moment. And obviously a much weaker dollar will be very good for the metals themselves.
Well, thank you very much, Phil, for joining us. As I said at the start, this is the first of regular chats with different people around the world. So thank you for joining us.